We're heading hard for the end of October, and so there's a couple of things on the horizon. The first of these is obviously Christmas, but before that, we've got the Chancellor's Autumn Statement on the 23rd of November. So we thought we'd have our own little giveaway before the Chancellor has his turn, and we've come up with 5 tax-saving ideas for extracting profits out of your company. Now, these are only ideas, and if you want to find out how best to implement them in your own circumstances, do come along and speak to us. The first of these is an old chestnut, small salary and a dividend. Small salary, we normally recommend taking £672 a month. Dividends up to 35,000 because this uses up the basic rate band, and also any spare personal allowances over and above your salary. There's no tax on the salary, and you pay 7.5% on the dividend after the first £5,000. Pension contributions are a good way of extracting money from the company. Now, if you're paying money into a personal pension out of your own money, then you're very restricted on what you can put into the pension. But the limits for a company are far higher. In the current year, a company could contribute £40,000 to your personal pension, and if you haven't used your allowances in previous years, it can be considerably higher. Consider putting this into a SIPP. The SIPP can buy commercial property, which might be your own premises, which you can rent back to your business. Now, if you've got children at university, consider transferring shares in your trading company. There's no capital gains tax on the gift, and you would transfer enough shares so that they get a dividend of £5,000 a year. This should be enough to cover a lot of their expenses, but if they need more and they're not using their personal allowances, then you could pay up to £11,000 more in dividends. If you're getting close to retirement, here's a cunning plan. Stop taking so much out of the company as dividends and salary and borrow the money instead. The company pays 32.5% over to the revenue, but then when you liquidate or sell your shares in the company and pay tax at only 10% because of entrepreneurs relief, you then repay your loan and the company gets the tax back. Finally, have you considered paying your spouse? It depends on their other income, but you've got their personal allowances which you could use up, so pay them up to £11,000 a year. And also consider transferring shares so that they can receive dividends to use their basic rate band. Now, as I've said, these are just ideas, and it's important that you come and speak to us if you're unsure how to best implement them in your own circumstances. The tax system might not be as benevolent as it once was, and you are inevitably going to be paying more tax as time goes on. However, we're here to help you keep it to a minimum. I'm Alan Long from the Long Partnership, making life less taxing.